Hi, welcome. Hi, good evening, and welcome you all for this today's webinar on Insolvency and Bankruptcy Code, interplay with the interplay of IBC with the income tax. So in next 55 minutes, we will discuss in a very detailed manner how the income tax will come into play, or we can say that how the income tax will play a very good role as far as this restructuring under this IBC is concerned. So we will discuss in next 55 minutes. And in last 5 or 10 minutes, we will take a question and answers, if any. So now let's start our discussion for this today's webinar. So this is the agenda for this today's discussion. So we will discuss about the overview of this Insolvency and Bankruptcy Code 2016. How the what type of the debtors and creditors are there, and what is the applicability of this the Insolvency Bankruptcy Code. We will discuss just some key sections which are very important as far as the income tax part is concerned. We are not going to discuss how the insolvency is going to be initiated. What is the process of this insolvency in the IBC code? We will discuss about how the income tax will come into play as and when you will do the restructuring under this IBC code. So we will discuss some 5 or 6 sections which are very important. So next we will discuss about this what is the nature of the income tax liability under this IBC code. So we will discuss about the waiver of the loan and other liabilities under this income tax. What is the MAT implications? What would be the accounting treatment for this loan waiver, because the loan waiver is a major chunk item as and when you will do the restructuring under this IBC code. So we will discuss about the merger and demerger under this IBC, how the income tax will come into play, and the losses treatment under section 79. We will discuss about this sections 56 to 10 and 50C, which is the deeming section of this income tax, and how these sections will come into play when you do the restructuring under this IBC code. And in the last but not least, we will discuss some miscellaneous sections like how the notices will be issued under 148 or compliance of section 281, and how the GAR will come into play when you do the restructuring. So this is the agenda for the next 55 minutes. So now let's start the discussions on some key sections of this IBC code 2016. So this is the preamble of this IBC code. So preamble of this IBC code was the IBC code was enacted in May 2016, and the preamble was, the basic motive was to consolidate all the existing laws and to facilitate a resolution in a very time-bound manner. So that was the basic purpose of this this IBC code 2016. But it includes a very important part as well in the preamble part. It includes the alteration in the order of the priority of the payment of the government dues, because in the IBC code 2016, there's no any specific criteria what is the nature of the income tax liability, right? So how the income tax will be part of this IBC code, and what would be the treatment to payment for the payment of this income tax dues. So that is in the preamble itself, it is mentioned that if there's any alteration, so how the method of the distribution will be there. So that has been mentioned in the code itself. So right, so that is the preamble of this IBC code. 2 terms is very important as and when you will do the restructuring or the resolution process under this IBC, either by the debtor or by the creditor. So now the question is, what is the debtor and what is the creditor? So debtor means basically a person, a corporate person who owes a debt to any person, right? It's a debtor. Creditor means to whom a debt is owed, right? Like a bank has given a loan to someone else, like the X company. So banker will obviously will be called a creditor, and the X company will be called as a debtor. So these 2 persons can initiate the resolution process under this IBC code. And in the creditor's part, there are the further 2 categories. Either it can be a financial creditor or it can be an operational creditor. So now, what is the financial creditor and what is the operational creditors? Financial creditor means a person to whom a financial debt is owed, right? And the financial debt, which has been specified in section 5 clause 8, that And financial debt means an interest disbursed against consideration for the time value of money and includes specified borrowing. So that means in common layman language, we can say that a bank's or the borrowing part basically, right? It's purely financial debt. Now the question is, what is the operational creditors? So we can say that anything which is other than the financial debt is called the operation creditors. So operation creditors could be your in respect of goods or services, including employment, or debt in respect of payment of dues under any law, and payable to the central government, local authority, or to the state government, right? So that category will be part of the operation creditors. Now we are going to discuss this interplay of the IBC code with the income tax. Now the question is, basic question which arises is, what is the nature of the income tax liability under this IBC code? The answer would be, it would be my operational debt. Income tax liability or any other liability which is relating to the taxation part, like the sale tax or any other statutory dues, will be part of the payable to the central government. And we will try to link with the judicial pronouncement as well. What is the nature of the income tax liability? Now the basic answer is that yes, income tax liability would always will be my operational debt. There's another section under this IBC, section 31, which is called the resolution plan. So resolution plan has been defined under section 5, clause 26. It means a resolution plan means a plan proposed by resolution applicant for insolvency resolution of the corporate debtor as a going concern. So now the word is as a going concern. So going concern has not been defined in anywhere, right? So now when we will interplay or when we will do the discussion under the Income Tax Act, so there is another term called the going concern basis, right? So what is the going concern? Neither in the income tax nor in the insolvency code has been defined. But here in the explanation in the section 5, clause 26, we specified that the resolution plan may include the provision for the restructuring of the corporate debtor, including by way of merger or demerger, right? So under this insolvency code, as and when we will do the restructuring under the IBC, it could be your buyout, simple buyout through share purchase, or it can be merger and demerger as well. But when we will discuss about this demerger under this income tax section 219, clause 19AA, so they have specified some conditions for the tax neutral demerger. So one clause is that it should be going concern. So the going concern has not been defined in neither in the Income Tax Act nor in the IBC. So we will discuss in the subsequent slides how this going concern will come into play when you will do the demerger under the IBC vis-a-vis with the income tax part. Section 31 specifies that as and when the resolution plan is approved by the educating authority, right? So that means that as and when the resolution plan is proposed by the resolution applicant, that have to be approved by the educating authority. So that is section 31. Then another term is says that the resolution plan shall be binding on the corporate debtor, employees, every person, including the central, state government or any local authority relating to any debt. Now the question is the income tax liability, right? Income tax liability. So as and when the resolution plan has been proposed, suppose there's a 1,000 rupees is the debt in the company's balance sheet, in the company's financial, but the resolution plan proposed was 400 rupees. And the taxation part was the 100 rupees. So how this 100 will be part of the 400, which is approved under the resolution plan. So now how this 100 will come into play, how the income tax will come into play as and when the resolution plan has been proposed by or approved by the educating authority under section 31 of the IBC code. So whether the resolution plan, the basic question is whether the resolution plan will be binding on the income tax authority. So now so far we have discussed that the income tax is a part of the operational creditors, right? Operational debt. So now second question is that section 31 specifies that it is binding on everyone. So as and when the proceedings are going on or as and when the outstanding amount is there from the income tax side, so it will be binding on the income tax, right? So there's some judicial pronouncement we will discuss and we will try to link how this binding and the judicial pronouncement will be there, right? So the answer would be yes, it will be binding on the income tax dues as well. So now, as and when there is a distribution of the assets under this IBC, there's a priority of payment which has been specified. 5 or 6 criteria has been mentioned. The priority list. We can say that there's a hierarchy: level 1, level 2, level 3, or A, B, C, D, E. So under the A part, the first priority would be given to the process cost, right? What would be the process cost for the resolution part that will be distributed, or that would be allocated on the priority basis. The second hierarchy that has been given under section 53 is the workman dues, which is pertaining to the period of last 24 months, and the secured creditors. Secured creditor means against which the security has been there and which has been registered. The C part, or the third part, is that wages and the unpaid dues for the workman for period of 12 months. The fourth level of hierarchy is the financial debt owed to the unsecured creditors. And the fifth part, or the E part, is that any amount due to the central government, state government, or any amount to be received on the account of the consolidated fund of India, right? Meaning thereby that the income tax liabilities payment, how the amount will get distributed in case of the insolvency of these IBC companies under the IBC code. Suppose 1,000 amount is the debt and 100 rupees is the income tax liability. How this, at the time of the liquidation of the IBC companies, how this 100 will get distributed to the income tax department? So that is the question. So the answer would be the income tax liability will be part of the operational debt, right? And as per section 53, at the time of the distribution of the amount relating to the debt part, it will come at the level of the fifth level, meaning thereby that it will be part of the amount due to the state governments or the local authority or any other state government, central government, or any other the statutory part. Others liability are given like the unsecured creditors or the preference shareholders. So the rest part would be given to the equity shareholders. So the interesting question is that the income tax liability will be part of operational creditor first. And at the time of the liquidation of the IBC companies under section 53, the level of the income tax liability would be fifth, right? But there is some judicial pronouncements. How this income tax liability will be, whether the income tax liability will be secured creditor as well, apart from this, the operational creditors. So there's some judicial pronouncement as well. So we'll discuss this. There are the two judgments of this Honorable Supreme Court. One judgment is Ghanshyam Mishra case, which specifically held that the income tax liability would be my operational creditors, right? As held by the Supreme Court. And it is held in the under the IBC code as well, which has been confirmed by the Supreme Court. Now the question is, at the time of the distribution of the assets under section 53 and section 31, approval of the resolution plan and binding on the everyone, including the central governments, local authority, or the state government, the question would be, suppose in my previous example, 1,000 rupees is my debt in my financial statement, and there was approval by the educating authority of 400 rupees of a particular company which has gone into the IBC part. So 400, which includes the bank and the other secured creditors and the wages part, but 100 rupees, which is pertaining to the income tax liability, was not mentioned. So that means the 100 was left out and 400 was approved by the educating authority. So as per the code of 2016 IBC code, this is my operation creditor, right? The Supreme Court held that as and when this resolution plan has been approved by the educating authority, it is binding on everyone. So, and the second thing is that anything which has been left out at the time of the approval of the resolution plan, you can't go and ask for the money from the educating authority, why my amount was not included. So meaning thereby that if the income tax liability has not been mentioned or has not been allocated under my resolution plan under the IBC code, the income tax will not be treated as a secured creditor. It will always be my operational creditor. So that means anything is left out, you can't go and claim for my liability part. So that is the Ghanshyam Mishra case, right? So it would be my operational creditor per se, and as and when the approval, the plan is proposed, you have to follow it, right? But whatever is left out, you can't go and claim to the executing authority why my amount was not included under the resolution plan. That is the Ghanshyam Mishra case. Now, the interesting part is that there is one more judgment, latest judgment, rainbow paper case judgment, right? So there's a latest judgment under by the Honorable Supreme Court, which has specifically categorized that no, this income tax, this taxation part is my secured creditor. Secured creditor means that, so I have a priority over the other creditors as well, right? So in my previous example, suppose 1,000 rupees is the debt in my balance sheet and 400 is the approval plan, and 400 was allocated to the secured creditors only, like banks and the wages and the whatever the priority payment which has been mentioned under section 53. So now under this judgment by this Honorable Supreme Court that of the rainbow paper case, this income tax liability will be my secured creditors. But this case is a peculiar to the sale tax law, not relating to the income tax part, but the interpretation is that if there is any taxation part is due, it will be treated as the secured creditors. But the facts of the case was that the sale tax department has a rights over the assets at the time of the, if there is a fault from the company side or from the assessee side. So in that case, the Supreme Court has held that because the sale tax department or the VAT department has a security against the assessee, so that's why they have a priority over the other payments. So that means they will be treated as a latest. They will be treated as a secured creditors rather than the operational creditors. But now from this judgment, the latest judgment from the Supreme Court, the income tax department is relying on this judgment because they are now treating themselves as a secured creditor. So now the question would be whether we will apply the Ghanshyam Mishra case or this rainbow paper case. So that's a very dilemma as far as the taxation part is concerned, whether the taxation would be treated as a secured creditors or operational creditors. From my personal opinion, the Ghanshyam Mishra case would be applicable because the code has itself specified that the taxation would be part of operational creditors. But this rainbow paper case, it's a peculiar facts relating to that because the sale tax department has a security over the assets over the assessee. So that's why they have categorized themselves into the secured creditors. So they are the two judgments which is play a very good role as far as this the categorization of the taxation part is concerned. So now let's discuss with the interplay of the IBC with the income tax. So as and when we will apply either the Ghanshyam Mishra case or rainbow case or section 31, which is binding on everyone, or 53 of the IBC code, right? Then now the question is that if suppose in my previous example of 1,000, right, 400 was allocated, and now you can apply the Ghanshyam Mishra case, the income tax will be part of your operational creditors, right? And you will be come at the fifth level as far as the hierarchy level is concerned. So now this 400 is pertaining to my secured creditors. So as and when there's a reduction in the liability, because the income tax department will not get anything, right? So 100 rupees is pertaining to the income tax department. Out of 1,000 and 400 have already allocated to the secured creditors, which is as per my resolution plan and which has been approved under section 31. So now the question is how this 100 will be treated under my income tax liability as in when there is no any subsequent receipt by the income tax department from the assessee side, because the resolution plan has already been approved. So there was no any section in the Taxation Act, in the Income Tax Act, to specify that how this 100 will come into play or how this 100 will be treated by the income tax department. So from 2022 Act, Finance Act, they have introduced one section, section 156A. They specifically mentioned that wherever any tax, interest, penalty or any fine which is payable for the income tax department pertaining to the IBC code and which has been approved by the educating authority, the department will issue again a notice of reduction, right? which will be called modification and revision of notice under section 156A. Because there was no any section. So now they have introduced a section that, okay, 100, if suppose out of 100, they are going to get 20 rupees only. So they will raise another demand for the modification by under section 156 of 20 rupees only. So, right. So they have introduced that section for the modification of the notices and or interest penalty under section 156. Now, it's a very interesting one related to the waiver of loan, because under the IBC, the major chunk of the item is relating to the waiver of loan part, right? Because the companies is already into the stress mode, they can't pay their loan. That's why they have gone into the resolution process of the IBC code. So major item relating to the waiver of the loan, 1,000 rupees is my debt, and suppose 400 is my resolution plan, proposed resolution plan is pertaining to debt only. Now let's take an example of the debt only. I've taken a loan from the Punjab National Bank of 1,000 rupees, and they have proposed to pay only 400, and 600 is the waiver of amount. Now let's take this example and we will continue with discussion with this in the subsequent slides. So waiver of loan is a major item which has been proposed or which has been taken by the educating authority under this insolvency bankruptcy code. Now the question would be how this waiver of loan will come into play as and when the income tax part is concerned. So waiver of loan could be term loan or it could be working capital loan. Term loan basically for the capital purpose, like you want to buy a machinery or building for construction purposes. Working capital means CC or the overdraft facility which you will take for the day-to-day business purposes, right? There could be a waiver of interest as well, right? So we will discuss both these things, waiver of loan and waiver of interest. So we will discuss first about the waiver of loan. Suppose 600 rupees is my 1,000 rupees is my debt in my books of account. 400 is the proposed plan, and 600 I'm going to waive off or going to be waived off by the banker, right? So how this 600 will come into play? So it could be under section 41 or it could be section 28 clause 4 and 194 are under the TDS part, which was introduced in 22 Act, right? So now the question is, at the time of the waiver of loan, whether the section 41 will get attracted or not. Section 41, the basic purpose of the section 41 was where any allowance, the relevant extract is as under, like where an allowance or deduction has been made in the assessment for any in respect of any loss, expenditure, or a trading liability, right? And in subsequent and in any subsequent during any previous year, the first mentioned person has obtained, whether in cash or in any other manner whatsoever, any amount in respect of such loss or expenditure, meaning thereby that whenever you have taken a deduction or an allowance in the previous year and the subsequent years you have get some remission part, right? Only and only in that case the section 41 will get attracted. So now the question is, at the time of the loan, whether we have taken the benefit of section 41, the answer would be no, because the loan is not deductible item. Interest is my deductible item. So I have not taken the deduction or allowance under section 41. So that means at the time of the waiver of loan, I will not get any benefit of section 41. So that means waiver of loan will be out of purview of the section 41. So now the next thing is that whether the section 28 clause 4 would get applicable. Benefit, the section 28 clause 4 was amended in 2023 as well. So there's a very good debate that was happened at the time of the budget scenario, how this loan amount, waiver of the loan amount will be taxed under the section 28.4 or not. So we will discuss with the Erstwhile Law before the Amended Act 2023, and then we will discuss how this Amendment Act by this Amended Act 2023 will give a clear picture about this, the waiver of loan treatment. So before this 2023 Act, there were the three ingredients for any income which will be part of section 28 clause 4. The first thing is that benefit or perquisite should arise to the recipient. The second thing, which is a very important one, is that should arise from the business or exercise of profession. The third thing is that whether convertible into money or not. So that was changed. whether convertible into money or not from this Finance Act 2023, we will discuss it. So we will discuss what is the benefit or perquisite. So benefit or perquisite has not been defined in the Act. So as per this, we will take the guidance from the dictionary. So benefit would be fruit, the benefit or advantage in simple terms. There's a one judgment by Honorable Gujarat High Court, wherein it has mentioned that what is the meaning of the benefit, right? So benefit would means any advantage, gain, or improvement in conditions. That is the basic definition which has been given by the Gujarat High Court. Perquisites, again, the perquisite has not been defined, but in terms of the salary part, yes, it has given the inclusive definition. So again, what is the perquisites? Perquisites would be a privilege or benefit given in addition to one's salaries, right? So both are synonyms, like whether you can take the benefit or the perquisite part. This is the first condition which will be part of section 28, clause 4. And the another term is arising from the business or profession, because as and when we will discuss about this, whether the loan waiver of would be part of 28.4 or not, we have to see the terminology which has been mentioned, that arising from business and profession, because as and when we will discuss or we will have a debate on the section that whether the waiver of loan will be get applicable or not, and most of the times we forget about the concept like arising from business or profession, unless and until the loan or waiver of arising from the business profession, I can't say that it is taxable under section 28.4. And what is the meaning of the arising from business and profession? It has not been defined. So from the judicial pronouncements, we will discuss it. So it should be benefit or perquisite should have a connection with the business or profession of the recipient and not with the business or profession of the person providing the perquisite or benefit. So that means if you have taken a loan from the Punjab National Bank, the benefit or perquisites is not from the point of the PNB. It should be providing to my company or to my SSC or to myself as well, right? Whether I am into the dealing of the loans or not. If I am into the manufacturing sector and I have taken a loan from the PNB, the question would be the loan taken by me or by my company from the PNB, whether it is arising from the business or profession or not. That is the key term which have to be followed under section 28.4. So there's a couple of judgments which I have mentioned by this Gujarat High Court and the Bombay High Court, wherein it has been mentioned that unless and until there is a live connection or a connection with the arising from business of the assessee, we can't say that it's the nature of the income which should be taxed under section 28.4. There's another judgment by Visakhapatnam tribunal, tribunal, wherein it is also mentioned that it should be a live connection with the business of the recipient. Unless and until there is a live connection with the business of the recipient, we can't say that it's a taxable under the section 28.4. There's a very specific judgment by Gujarat High Court in Chetan Chemicals, right? Wherein it is mentioned that in case of remission of loans or waiver of loans, right? It's not the business of the assessee. So we can't say that the section 28 clause 4 will be applicable under section 28.4, right? So there's a two judgments of this Gujarat High Court. One is the Chetan Chemicals and another is the Gujarat State Fertilizers. They have specifically mentioned that this terminology arising from business or profession. So we need to keep in mind what is the meaning of the arising from business profession, because there's a lot of debate, lot of questions arises whether the loan waiver of will get taxable or not. We need to see arising from the business or profession or not, right? Third leg of this section 28.4, whether convertible into money or not. This is the unamended act before the amended act 2023. Whether convertible into money or not, there was a judicial interpretation taken by the various high courts various courts that for a loan waiver or for any term or for any benefit which will be part of 28.4, it should be benefit arising from other than monetary benefit. Means it should be the benefit in kind only, which will be part of section 28.4. That was by the interpretation by the various courts. Mahendra and Mahendra is the famous judgment which has set a law that waiver of loan is my cash benefit, and it is not a part of the section 28(4), right? So that means waiver of loan can't be part of section 41. It can't be part of section 28(4). So that means waiver of loan will always be tax free. So meaning thereby that the Gujarat High Court in the another judgment also had the same view that the waiver of loan is my monetary benefit and it's out of purview of section 28(4). In some cases, the nature of the loan, right? Purpose of the loan, we can say that it could be capital purpose or it could be revenue purpose. They have specifically categorized that if you will be part of the capital category, it will not be treated as a, or we can say that it's a term loan, it will not be treated as income. If it is a working capital loan, it's part of the income. So there's a very famous judgment of TV Sundaram, because most of the time the tax department want to invoke this judgment, because that was a very peculiar case wherein the assessee got some deposits. Assessee was into the bottling business and they got some trade deposits from the customers, and by the period of time they have treated this deposit into the business income. So the question was whether this the deposits write off or written off from the books and treated as income will be part under section 28(4) or not. The court held yes. Court held that yes, it's part of business income, because by the passage of time it become your business income, because the assessee was into that business of trading of the bottling and they got some deposits from the customers, right? So that is a very peculiar case. The another judgment by the Delhi High Court in Logitronics, wherein it has been held that if it's a term loan, it would not be part of your income. If it is a working capital loan, it would be part of your income. Forget about the section 28(4) that whether it's a convertible into money or not, because there's a couple of judgments which they have specifically mentioned that if the loan is part of working capital, it will be taxable. If it is not part of working capital, or we can say that it's part of term loan, it would not be treated as a taxable income. Another judgment by the Madras High Court, wherein it has been mentioned that the waiver of loan would be part of your income, but that was overruled by the Mahindra and Mahindra, wherein it has been mentioned that waiver of loan would be your monetary benefit and it is not part of section 28(4). Now, what has got changed from 2023 onwards, right? Because the Mahindra and Mahindra judgment, the Supreme Court held that the waiver of loan is a monetary benefit and it is not part of your section 28(4), right? So it will be out of purview of the taxation as far as the waiver of loan part is concerned. So now, to overrule that judgment, or to just to clarify the matter, that the memorandum was the memorandum was proposed, wherein it was mentioned that the intention of the legislature was to cover both items, whether it's convertible into money or in kind or in cash. So that they have just clarified the matter by introducing this amendment in the Finance Act 2023, wherein they have mentioned that the value of any benefit or perquisite arising from business or exercise of profession, whether convertible into money or not, in cash or in kind, partly in cash or partly in kind. So that meaning thereby that the Mahindra and the various other judgments which we have discussed in the previous slides, which they have categorically mentioned that the monetary benefit, because the waiver of loan is your monetary benefit, it would be out of purview of section 28(4). But now this Finance Act 2023, they have introduced this amendment by giving the clarification that it would include both, whether in cash or in kind. Now the question is how the income tax will come into play as far as when you write off or get the waiver of loan from your banker, right? So there are the four ingredients under this amended act. One is the benefit or perquisite should arise to the recipient. That was also there in the erstwhile section. Should arise from business or profession, whether convertible into money or not, or in cash or in kind. So that was recently introduced by Finance Act 2023. Now the question is how the waiver of loan will be get treated under this taxation part is the section 28(4) part is concerned. So Mahindra and Mahindra, so meaning thereby that by amending this section 28(4), they have overruled the judgment of Mehndra and Mehndra of the Supreme Court that it will include both whether convertible into money or not. Now the question is how the section 28(4) will come into play, because the Supreme Court had set a principle of law that waiver of loan will not be part of 28(4). It can't be part of 41. But Supreme Court did not discuss about the matter of arising from the business or profession. They have settled a law that, okay, it's a monetary item, it will not be part of. Most of the cases, we just relying on the judgment that it's a monetary item, it will be not part of. But now the question is whether arising from business or profession. So as categorically settled by the Gujarat High Court in Chetan Chemical that we've discussed. So we have to see whether the waiver of loan is my part of business. So now let's take example, 1,000 is my debt. I am into the manufacturing sector and I have taken loan from the banker. The banker has waived of 600 rupees from my books. Now the question is, the 600 rupees, what would be the treatment of the taxation part is concerned? It can't be part of section 28. It can't be part of section 41. So whether 28(4) would be there, meaning thereby that by taking the impact of the Finance Act 2023, they have taken that, okay, the monetary benefit is also part of the section 28(4). Now we have to see whether the arising from business or profession is the definition or the condition is fulfilled or not. If I am into the NBFC business and I have taken a loan, this is my personal opinion, and if I have taken a loan from the bank, I am into the dealing of the business of the loans. That means the 600 rupees I am getting a waiver. So definitely it is part of my section 28(4) business or profession part. But I am into the manufacturing sector. I am not into the business of the taking a loan from the bank. So that means now the question mark would be there. What would be the treatment of the 600? So that means if I am taken the monetary benefit that they have taken that they have changes in the law by the Finance Act 2023, but they have not discussed about the arising from business or profession, because most of the judgments they have stressed on the whether convertible into money or not, right? So we have to check whether I am into the business of in the taking of loans or not, as per this the Gujarat High Court judgment of the Chetan Chemical. So that because it will settle the law that unless and until I am into the business of the taking loans, I can't be held as a taxable under section 28(4). So now in last year 2022 Act, they have introduced section 194R, right? The tax implications under the perquisites part. So the CBDT has issued two circulars, circular number 12 and 18 of 2022. So wherein they have clarified some matters in related to the waiver of the loan. In one of the item, they have mentioned that if any loan settlement by a specified institution, they have specified what is the specified institution. The one party is the bank and the other financial institutions would not be subjected to the tax deductible at source under section 194R, like the banks or the other financial institutions, scheduled banks, commercial banks. If they are going to waive of loan, so they don't need to deduct the TDS under section 194R. So now the question is, if there is any other party which is not part of the specified borrower, means if a holding company has given a loan to the subsidiary company and they have waived of the loan. Now the question is, in case of the waiver of loan, the 194 will be applicable between holding and the subsidiary company. So there is no any clarification. But from the interpretation part, the answer would be yes. Waiver of the bad notes, there is no any clarification in whether the benefit or whether it will be part of the benefit or perquisites or not, right? So the one more treatment, one more clarification which has been given by the CBDT, that the TDS conditions need to be fulfilled, irrespective of the fact that what is the tax implication under the law. If the waiver of loan is there and they have categorized, they have fulfilled this specific criteria, you need to deduct TDS. Whatever the implication under the tax law, that's a different matter, right? So now, apart from the loan, there could be a waiver of interest as well. So in the waiver of the interest expense is allowed under section 36, subsection 1 and clause 3. If the interest part is get deducted, and you are going some waiver in the subsequent year. So that means the section 41 says that if the deduction or allowance which you have taken in the previous year and the subsequent years you are obtaining any benefit in cash or in kind, so that means that is taxable, right? So section 41 will get attracted as and when the interest part is remitted by the banks or the financial institutions. Now come to the accounting treatment part, right? So what would be the accounting treatment of the waiver of loans? Like, so in case of companies, either we can apply the accounting standard or the Ind AS. Accounting standard, there's no any specific clarification or what would be the treatment, but it's not my ordinary business. I can say that it's part of my income. So there's some opinion from the Institute Expert Advisory Committee that it can be part of the capital reserve, right? Capital reserve. So waiver of loan, 600, the 1,000 is my debt and 400 is I'm going to pay and 600 is my remission part. So 600 would be part of the capital reserve. There could be another argument that why it's part of capital reserve. But when the company is applying the Ind AS, there is specifically held that section, the Ind AS 109, which specifically held that in case of extinguishment of a liability, so loan is my liability, right? So 600 is my liability I'm going to waiver from my banker. If I'm going to apply this Ind AS 109 says that, Ind AS 109 says that it will be part of profit and loss, right? If I'm applying the old standards, means the gap, it's part of my capital reserve. If I'm applying the Ind AS, it's part of my profit and loss, right? So that is the difference. So now, if it's part of my capital reserve, if it's part of my P&L, how the MAT will come into play? Now let's discuss. Minimum alternate tax, 115JB. So there is no specific exemption relating to the IBC companies, first of all. Loan and waiver, if it's credited to the P&L, it will be part of MAT book profit and you have to pay the MAT. If it's part of capital reserve, that means it will not be subject to MAT. Now the question is, if I am going to park my loan waiver of under the capital reserve, whether the AO has a liability, AO has a power to recast my profit and loss, the answer would be no, because you can apply the Polo judgment of the Supreme Court. Whatever the profit and loss which has been audited by the auditor, you need to take it. And you have to take the adjustment as per the explanation which has been given under section 115JB. Right? So that means the capital reserve, so capital reserve is a better position for me. But I am applying the Ind AS. India specifically says that, okay, boss, you have to treat it park as a profit and loss account. So that means there's a disadvantage for me. So still there is some other judgments which specifically held that, okay, waiver of loan is a part of your capital nature. Although you have taken into profit and loss, we will not charge the tax under the MAT procedure under 115JB, like the JSW by Mumbai Tribunal, Shivalik Ventures, and Shri Cement. So the tribunal has given a judgment in favor of the SEC that because the nature of the loan was a capital and you have treated and you have waiver, you got the waiver from your lender and it is parked under your profit and loss, but it is your capital nature. So that will not be included under the book profit part. On the flip side, there's a couple of judgments which held that although it's part of profit and loss, still you have to pay the MAT, right? So it's purely depends upon the judicial judgments. But my opinion, personal opinion, the JSW judgment which I have discussed, the Mumbai Tribunal judgment, we specifically held that because it's a nature of the capital, you don't need to pay MAT on that part, right? So there are both sides, the judgments which have held in favor of assessee as well as again in the favor of the department that the loan waiver of can be part of book profit or cannot be part of the book profit. Under the MAT, what would be the treatment of brought forward losses and depreciation? Because there is no any specific exemption for the IBC companies, and in the MAT part, the lower of the unabsorbed depreciation and the brought forward loss will get adjusted, right, as per the section 115JB. But in case of the IBC, because they are into the losses, otherwise the losses and the depreciation will get left off. So that's why from 2018 onwards, they have introduced an amendment in the Income Tax Act, wherein they have mentioned that total of the brought forward losses and unabsorbed depreciation will be allowed for the IBC companies, right? So So the benefit is that both the losses as well as the depreciation. For all other companies, it's the depreciation or lower of the depreciation or the unabsorbed losses will get allowed under the section MAT part. So section 79, suppose you are going to buy a company wherein the private limited company or the public in which not substantially interested, and there's a change in the shareholding on the beneficial part of more than 51%. So the company will not get the benefit of the unabsorbed losses, right? Not the depreciation, but for the unabsorbed losses. So keeping in mind of the IBC procedure, so they have given some relaxation wherein they have mentioned that, okay, we will allow it because under the IBC part, the most of the companies would be there wherein the change in shareholding would always be there. And the company will always into the losses. That's why they have gone into the liquidation part or under the IBC. So the act, they have introduced the amendment in the Income Tax Act in the section 79. They mentioned that we will allow it if there's a change in the shareholding of more than 51%. We will allow the losses provided that a reasonable opportunity need to be given to the jurisdictional or principal commissioner. But what is the meaning of the reasonable opportunity? They have not defined, right? So that means before the changing the procedure or before the plan of the resolution plan under the IBC code, so some reasonable opportunity need to be provided to the tax department that we are going to, there's a change restructuring of the business, and the losses will get allowed, right? So that is the procedure under section 79, wherein there some benefit has been given, wherein if there is a change in the beneficiary holding of 51%, the losses will get allowed to the acquirer. Merger and amalgamations under the IBC part. So under this Income Tax Act, so as per the section 5 of the resolution plan may include the merger and the demerger part, right? But for the taxation part, it should be tax neutral, right? And for the losses part, they have specifically mentioned that if there's a losses, you need to fulfill all the conditions. But for the shareholder and for the company's part, section 47 is specifically mentioned that, okay, no capital gain will need to pay for the company part, as well as for the shareholders. The shareholders will also don't need to pay the tax at the time of the merger or the amalgamation. But in case of the losses, because there's a general thing is that the all IBC company, most of the companies, the losses would be there. To get the benefit of the losses part, the acquirer, the amalgamated company need to take advantage of the losses of the amalgamating company under the IBC part. But under section 72A, there are some conditions which need to fulfill. First thing is that industrial undertaking definition. So that has not been changed, or some relaxation has not been provided for the IBC companies, because the industrial undertaking definition could be your manufacturing company. Suppose I'm a service company or some other company which is not getting fulfilled the criteria of the industrial undertaking, like hotel which has been mentioned, or any condition which has not been specifically meeting out the definition of the industrial undertaking under section 72 of the Income Tax Act. So that means I'm not going to get benefit of the carry forward of losses under the amalgamation part. So that is a very thing that I think government need to decide how the losses of the amalgamating company will be benefited by the amalgamated company, and some other conditions like the production capacity of 50%, and the amalgamating company should be a period of running of 3 years old, and book value of assets need to be held by the amalgamated company of 3/4 of book value of assets for at least 5 years. So all these conditions has to be fulfilled, but the specific criteria, they have not been relaxed for, particularly for the IBC companies. So that need to be taken care of. This is my personal opinion, by the government for the better the resolution for the IBC companies. Demerger part, as we mentioned in the previous slides, the going concern under the resolution plan of the IBC code, and the going concern as per the taxation part. So, but in neither case, in the IBC or the income tax, there's no definition of the going concern has been mentioned. But as per the judicial pronouncements, the going concern means that a concern which there's a one judgment called the Indorama of the Delhi High Court, wherein they have specified that the business undertaking definition, wherein they mention the Honorable Delhi High Court has mentioned that going concern means that a business which can be run independently. So suppose in a IBC situation wherein the company is into the stress business and how they can run their business independently. The question would be that under the demerger part, the section 2 clause 19AA, which there's many other condition. One condition is the going concern. So now the question is, if there's a demerger of the under the IBC, whether the going concern definition will be accepted by the income tax department, whether the demerger under the IBC will be tax neutral as per the Income Tax Act, section 219 clause A. So that's a very big question, right? So there's no any clarity how this going concern will play a role of this of the demerger part, right? So that's a very tricky question that we need to do a research, and because there is no any clarity on that part. Another thing is that in case of the restructuring of your business, it could be happen that your loan will get converted into the equity, right? A banker can ask that, okay, I have been very in a bad position, so I can't pay a loan in the monetary forms. We can convert your loan into the equity part. It is allowed, but section 29T will get attracted, wherein it says that the loan or deposit will be repaid by the account by check or through electronic mode. So whether the penalty would be attracted in case of the loan will get converted into the equity. So there's a couple of judgments. So I have mentioned there's a two judgments. One is the Kolkata Tribunal and the Bombay High Court, wherein it is mentioned that because there is no any actual flow of cash, the loan will get converted into the equity through the book entries only. Although it's a violation of section 269T, but the penalty which has been prescribed under section 271E, that will not get attracted. So, right. So this is a very normal phenomena wherein the IBC company will be converted their loan into the equity part. So the question would be, the penalty would get attracted or not? Yes, violation would be there, but because it's a very unique condition wherein the through book entry, you are going to convert your loan into the equity part. So penalty would not get attracted. So deeming sections of section 56 to 10 and 50 CA. So there is no specific exemption, because in most of the cases of the IBC companies, fair value would be different than the book value, because you are already into the stress condition. Fair value could be different and your book value could be different. So in terms of the receiver part, 56 to 10, where any sum of money exceeding 50,000 rupees, whether the section 56 to 10 will get attracted or not, right? And for the seller part, section 50 CA would get attracted or not. So there's no any specific clarification or specific any thought which has been mentioned in the law. But yes, because there's no any specific exemption, it would get attracted, but how they will get attracted and whether the same would get logical or not. So we need to rely on the judicial pronouncements, right? But yes, the litigation can't be ruled out on the terms of the valuation part from the both the receiver and for the seller part, right? So how these two sections will come into place, that's a very challenging one. Tax proceedings and claims during and after the resolution plan. So as we know that whenever the resolution is going to start, there's a moratorium under section 14. So it will apply to everyone, right? Including the tax appeals as well. So there's a provision of any further proceeding as and when there's a moratorium under section 14. So there's a couple of judgments that we have mentioned, like the first judgment is the Monet Ispat and Energy Limited, wherein the Supreme Court has held that the tax proceedings during between the moratorium period is not valid, right? So because you have to apply the IBC code. It's a very important one. The IBC has an overriding effect, right? So section 238 of the IBC, which has specifically mentioned that the IBC will get prevail over all any other law, right? So in case of any conflict. So the Supreme Court has held that in the Monet Ispat Energy, wherein it has held that yes, the code has specifically mentioned that it's an overriding effect over the other law, because it's a non-obstant clause which has been mentioned under section 238 of the code itself. In another judgment wherein alchemist assets, the Supreme Court has held that even the arbitration proceedings can't be initiated after the initiation of the moratorium, right? So that means because the taxation, the code 2016 is overriding code all over other law, including the taxation law. Keeping in mind the same thing, section 178, subsection 6 has been amended in the Income Tax Act, wherein it has been mentioned that the code of 2016, IBC code, shall have an overriding effect. So meaning thereby that, if there's any proceedings or any other tax due under the Income Tax Act, and the resolution plan has been given, so that means whatever is mentioned under the IBC, you need to apply it, right? We need to apply it. Carry forward losses and filing of return of income, right? So sections 80, because most of the companies under the IBC, they are into the losses, and you need to file your taxation return under section 80, and most of the cases there will be delay in the filing of the return of incomes. And what would be the procedure? So we can ask for the, we can take the reliance of section 119, subsection 2B of the Act, wherein there is a genuine cases, so we can approach to the CBDT for the late filing of return of income. And who will sign the income tax return? The insolvency professional under section 140. He is the authorized person to sign the income tax return under section 140 of the Income Tax Act. Section 281, the miscellaneous provisions, the first part is that the section 281, the clearance from the income tax department would be there as and when there's a sale and purchase of the property or the building or any other items, wherein you need to take the clearance of the section 281 under the Income Tax Act. The answer would be yes, but it's a time-consuming process. We need to take it. Whether any relaxation on the transfer property under the IBC stamp duty part, the answer would be no. We need to pay the stamp duty as well as and when you do the restructuring under the IBC. Applicability of GAR, right? So General Anti-Avoidance Rules, section 95 to 102, wherein if there is an impermissible avoidance agreement, so wherein the tax department can revoke your agreement and apply the GAR. But there's a circular by the CBDT wherein it has been mentioned that whenever there is an approval by the educating authority of the NCLT, so the GAR will not be applicable. What would be the treatment of the insolvency resolution process cost? Because under section 35 DD, there is a specifically mention about the treatment of the process cost of the amalgamation and the demerger part, but there's no any specifically clarification regarding the how the process cost will be treated, whether it would be 1/5 or capitalized or revenue part. So that need to be clarified by the CBDT. But so far there is no any clarification how the process cost will be treated under the taxation part. The last part is that whether the section 148 notice can be issued to the corporate debtor. There's a couple of judgments which have specifically mentioned that as and when the initiation of the process starts, of the resolution process starts, you can't issue a notice of 148 to the corporate debtor. So one important judgment by Honorable Bombay High Court in Morley Industry Limited, which has been categorically held that IT department is not authorized to issue a notice against the corporate debtor for the tax claims after the approval of the resolution plan. So most of the cases we've seen that the 148 notices are being issued to the corporate debtor even after the approval of the resolution plan. But the judicial pronouncement has categorically held that the section 148 notices can't be issued. So from that side, I am concluding my discussion. So I am open for the Q&A, question and answers. There's a one question that sometime the income tax department starts recovery proceeding against the corporate debtor for the old assessment years prior to the CRP, but order passed in CRP period. What do you do in such cases? The latest judgment which I have mentioned that by Bombay High Court, that Honorable Bombay High Court, that the tax department can't issue a notice of 148 as and when the resolution plan is approved. But yes, in cases where the resolution plan is not issued, is not approved, the tax department is authorized to issue the section 148. But as and when the resolution plan is approved, the tax department cannot issue the notice in section 148. The next question is, what would be the tax implication on the waiver of the cash credit? Because the cash credit, it would be a working capital loan, right? So there was a logistics judgment of Delhi High Court wherein they have specifically mentioned that waiver of loan, if it's a term loan, it would not be taxable. If it is a working capital, yes, it would be taxable. But yes, we need to see that whether it is arising from business or profession or not. It's arising, yes, it would be taxable under section 28(4), otherwise it will not be. The next question is whether the benefit of carry forward of losses will be available on the new management if the return of income of the previous year has not been filed within the due date as per the section. Yes, because there's a genuine case and we can approach to the CBDT under section 119 2B, wherein you can approach to the tax department, because it's not an easy thing to file the tax or the return of income on time. And in most of the cases, the assessee can approach are approaching to the CBDT for filing the cases for filing the return of income by taking the genuine cause. The next question is, suppose the share capital is 1,000, resolution has been finalized for 500. How the reduction in the share capital will be done? So the resolution, it will be treated as the reduction of the share capital as per the Companies Act, right? As per the Companies Act, you need to take the section of the reliance of the Companies Act particularly. During the moratorium period, if the IT department had adjusted the demand against refund due, what is the solution of the corporate debtor? So they can adjust the if the approval of the resolution plan has been there, so they can't do even the deduction or the adjustment of the refund with the tax demand. If before the resolution plan, they can adjust their demand, keeping in mind section 241 as well, right, of the Income Tax Act. The next question is, as per the resolution plan, there can't be any claims against the company for the period before the effective date. Will this applicable for CITA order passed in June? The question is, as per the resolution plan, there can't be any claims against the company for the period before the effective date, which is the 11th January. Okay, will this be applicable for the CIT? Yes, all claims, see, two things. One is the moratorium. Moratorium says that, okay, provision would be there. And in the second case, in your case, the proceeding is already been initiated. After the lift of the moratorium period, the proceeding will get starts. Suppose your case is already been with the appellate authority of the CIT appeals. Yes, the same can be held because it is under the judicial part, right? Kindly share the PPT for your reference. Yes, the Taxmann team will share the PPT. So I think I have cleared all my questions. So if there's any questions, so you can discuss me through my mobile number, or you can share your question to the Taxmann. I will try to sort out any other questions. So thank you, Taxmann. Thank you, participants, for your patience listening.